Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. I trust you're having a good day. Some interesting kind of sporadic data happening around the world. It wasn't a major data event. We did of course have a couple of Fed presidents making comments in New York yesterday and slightly differing views, although they did seem to think, as I do a little bit as well actually, that there's now less risk of a US recession, but I still think it is there. But I don't see a deep recession at this point unless the banking crisis or the commercial property crisis, if they blow up, then you could have a deep recession in the US. Without either of those events happening, and it is possible both will happen again, but without them happening, you've got a long period of lackluster growth in the US. US consumer remains very unhappy. Small bounce, but still a very unhappy GFC-style US consumer. And while we're speaking of confidence, over in Germany yesterday we had the ZEW confidence, business confidence index come out, and it fell rather sharply to around 4.1, which is a very low number indeed. It had started to look a little good at the start of the year, and as I said, with a lot of the economic data at the start of the year, it probably wasn't going to last. And we've got a distinct, definite rollover in confidence in Germany. And this might have something to do with all the demonstrations that are going on there as well, major demonstrations in the big capital cities. Sort of not as big as what's happening in France, of course, which is still on the edge of another revolution almost, but certainly significant. The concern, of course, among consumers, business managers in Europe remains the war in Ukraine. The investment community, and if you're a trader, you've probably been doing this too, the investment community, global investment community, has very much wanted to compartmentalize the conflict in Ukraine. Okay, we know what that is now, and it will stay in those confines. So I hope it does, and I hope there's a peaceful resolution, miraculously, somehow, for all the people of Ukraine. In the meantime, though, there are ongoing risks that the situation could flare up. And it's great that Europe got through the last winter, which was luckily mild without any energy sort of too severe restrictions. There were sporadic restrictions at times, and that energy prices in Europe have come down through government interventions, of course, as well as it's now well into their summer. Enjoy your summer in Europe. The next winter is coming, and if there's still a war raging in Ukraine, there's still going to be efforts that need to be made to keep the energy supply going and prices low in Europe. But also it's just a general feeling of it's not comfortable to have war on your doorstep. So that continues to impact consumers and businesses alike across Europe. We've also seen some other data today in Asia suggesting consumers are becoming a little bit circumspect as well. In Australia, we've seen the stock market and the currency both pushing to the upside today. This is largely on the back of better news starting to develop on the commodity front. I've been arguing for some time that energy prices, oil and other energy prices, were again headed higher, and I do continue to suggest, as I did a while ago, looking at that natural gas price in the United States, which I think is going to go back up a lot higher. And oil as well seems to be, volatile, but building for something higher, still towards $95, I think. But it was interesting. We are starting to see the occasional leap and jump in different commodities like tin, etc. And that is a positive for, obviously, Australian miners and the Australian dollar. So keep an eye on that. However, the US dollar maintains a, how should we describe it, troublesome image to the world for a whole range of reasons. As I've been saying for many months now, the only reason to buy the US dollar has been the higher interest rates, stronger yield, which is still very much there and likely to go higher, but it's offset, and you have to figure out how much it's offset by an economy that's in disarray. I've sometimes called it dysfunctional, but I think disarray is a reasonably accurate term for the US economy, without any resolution being in sight as such. So I think ongoing sort of sporadic economic behavior in the US. We saw building permits fall significantly yesterday in the US. The housing industry, we all know, is in recession. Construction industry there, the housing construction industry is in recession in the US. We've known that for, I don't know, 6 months, 9 months now. But it was good to see new starts, building starts, home starts, edge a little bit more firmly. But again, it's nothing to write home about. So overall, still great caution on property prices in the US, equity valuations, and on bonds. So I've been bearish bonds even through this period where everyone else has been very bullish. And I've been selling the rallies in the bond market in the US because I do think there is an argument for a shift of capital from the US to Europe and elsewhere, particularly in Asia perhaps. And that the whole idea of the United States being the only place and predominant place for people to have their capital, for global investors and portfolio managers to have their capital, those days are gone. So that will undermine the US dollar, all of those factors. So yes, bearish property, US property, bearish US stocks, bearish US bonds. It's not much left. The fiscal deficit continues to grow. There's still going to be a very heated discussion on the Hill about the debt ceiling. Obviously, it has to be resolved, but the Republicans are not at all happy with big spending Biden, and I think they're going to really push this to the nth degree. So watch for a real sort of live wire moment for the fiscal debt ceiling in the United States, and that will ring a cautionary tone to financial markets in general, but particularly US equities and bonds, of course, with some people talking of a risk of a default by the US government. Now, that is a real possibility. I don't see it happening, but it's a 5-10% possibility. It used to be a 0 possibility. So a lot of people are keeping an eye on that. Overall for markets, I think the US dollar is in a sideways consolidation pattern now. I do think it could be vulnerable to the downside, however. I would be watching this Australian dollar rally to not last that long. And I guess the big point on the currency markets at the moment is if you don't like the US dollar, the euro isn't necessarily the place to put your money. It has been of late, but it's come a long way and it still has its own problems there in the European Union that are quite significant. And point to economic disruption ahead to some degree. So I'm looking at other places to allocate funds and even to the renminbi, which is out of favor with a lot of Western institutions, particularly US institutions, but much of the world still is very happy to deal with China and increasingly trade with China in the renminbi. So it is the coming reserve currency. There is no doubt about that. It is going to be, as I've been saying for 14 years now, 12 to 14 years now, it is going to be the euro, the yuan, the renminbi, and the US dollar. So watch for that process to at some point really accelerate, and always have that in the back of your mind when trading currency markets from a medium to long-term perspective. So as I said at the start, a lot of sort of sporadic little threads here and there to pull together, but nothing really to tie a very strong quilt together at the moment. I'm just very cautious about this US equity market rally still, however. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.